Raising your first round of financing can feel impossibly overwhelming, especially when venture capitalists are not calling back and angel investors seem impossible to reach. But here's the good news. VCs and angel investors are only two of the many ways startups can raise first funds. Hi, I'm Afan, a former investment analyst and a startup growth advisor. I have been leading and advising several e-commerce and digital-first businesses for almost a decade and have helped several startup founders raise their first funds. Today, we are going to talk about four very powerful funding sources that thousands of founders use to raise first financing without giving big chunks of equity in their business. We will talk about crowdfunding, incubators and accelerators, grants, and SME or bank loans. We will also talk about which types of businesses does each of the funding type work best for. Now let's dive in and start with the first one, which is crowdfunding. Crowdfunding is one of the most accessible ways to raise first funds, especially if you have a compelling story or a product that can get people excited about before it's even launched. Crowdfunding has gained a lot of popularity and adoption globally. The global crowdfunding market, as per a study, already reached more than 17 billion US dollars in 2024 and is expected to reach almost 40 billion by 2029. So over a 4-year period, crowdfunding is expected to gain popularity or gain growth by about 20%. Social media campaigns here are a big growth driver, with successful campaigns raising an average of 28 to 30,000 US dollars and campaigns with videos raising 150% more than that. Now, there are three main types of crowdfunding: reward-based crowdfunding, equity crowdfunding, and donation-based crowdfunding. As the name suggests, reward-based crowdfunding is best for physical consumer products, hardware devices, creative projects, or innovative gadgets. For example, if you are launching a new smartwatch or a drone or a fitness gear, this is a great way to raise funding. And some examples of platforms that you can use include Kickstarter and Indiegogo. When we go into equity crowdfunding, this is best for consumer-facing startups which have a community aspect. Companies with strong branding, even if they are pre-revenue. Some examples here would include breweries and coffee brands, clean energy startups, and SaaS-based active user communities. A couple of platform examples here to raise funding include Seed Invest, vFunder, Crowdcube. The third type of crowdfunding is donation-based crowdfunding, and a popular platform here is GoFundMe. And typically, the kind of startups that raise funds here are social enterprises or companies looking to fund community projects and other non-profit entities. So, in a nutshell, crowdfunding is perfect when your product can excite people before it's built, and when you want to validate demand before launching your product. Next up is incubators and accelerators. Accelerators and incubators offer structure, mentorship, and network access, which is often more important than capital itself. But good news is that they often also provide small amounts of capital into companies that are part of their network. Incubators are usually early stage, focusing on building the idea and helping founders validate the concept, while accelerators, as the name suggests, are more focused on scaling. Naturally, many incubators feed into accelerator pathways. Incubators are best for idea stage businesses, prototypes, or founders who need structure and coaching. Tech or product businesses is still figuring out their model or initial product validation. They are great if you're still refining your business model or testing your first prototypes. And some examples here would include university based innovation hubs, local government supported technology parks, and community co working incubators. If you ask me some names, Y Combinator, TechStarts, Mass Challenge, and local innovation hubs are some of the examples of incubators. Accelerators, on the other hand, are more relevant for startups that are ready to grow, companies with early traction or MVPs or minimum viable products, digital startups, software as a service companies, direct to consumer brands, AI tools. Examples here include companies such as Techstars, Y Combinator, Mass Challenge. These programs can be quite transformative for a startup, often offering access to experienced individuals, mentors, investors, and alumni networks. Now let's move into grants. Grants are a dream scenario. This is non-dilutive money, meaning you don't give up any equity and you don't need to repay your grants. Grants come from governments, industry bodies, and private foundations, and typically they are focused on innovation, economic impact, and social impact. Grants are best for scientific research and development, sustainability and climate solutions that have a big economic impact, social impact initiatives, export related businesses, especially in countries where the government is having a big focus on boosting exports. And some examples here on the type of entities that may be providing these fundings would include government innovation funds and clean energy development grants. So if your work advances technology or helps solve a social or economic problem, then grants could be a great way to raise funding or early funding for your business. Finally, let's talk about loans. Loans are something that many startup founders avoid because they fear debt. But for certain types of businesses, loan can be a great, very smart way to get started without giving up any equity in your business. And loans for startups or new enterprises can take two shapes. First is traditional bank loans. These are best for businesses with some revenue history, e-commerce brands with some sales, professional services, retail stores, manufacturing, or food and beverage businesses. Examples of companies here would include a bakery that is looking to finance equipment, a fashion boutique that's looking to open its first storefront, a growing e-commerce brand that requires some funds to buy first inventory. Banks love stability. So if you have predictable demand or collateral, you are a strong candidate. Research shows that 59% of the small businesses applied for loans in 2023, with the highest approval rates of up to 52% coming from small banks and credit unions. It is also important to know that approval rates vary by type. 73% approval for equipment loans, 54% for real estate loans, and 46% for business lines of credit. The second type of loan here is SME or government backed loans. These are often easier to access with lower interest rates. These are great for early businesses without long financial history, startups needing working capital, founders who prefer lower risk than private loans. Examples of where to get these would include government SME guarantee schemes or startup friendly micro loan programs. These programs are designed to promote entrepreneurship in the country, so your approval odds can be higher than traditional bank routes. In 2024, the Small Business Association approved over 70,000 loans, totaling more than 31 billion US dollars, with an average loan size of almost half a million. So, raising your first round doesn't mean convincing VCs or angel investors. When venture capital isn't available or when venture capital isn't the right path, founders still have powerful options. Crowdfunding validates demand and raises early capital. Accelerators or incubators improve success odds and unlock very important networking benefits. Grants provide free, non dilutive funding. Loans support businesses with predictable economics. Remember, the best fundraising strategy is one that fits your business model, your stage, and your risk profile. If you found this helpful, hit that like button and subscribe to my channel.